Seth Carpenter's with me, Global Chief Economist at Morgan Stanley in New York. The Treasury Secretary, not exactly rousing in her confidence there when she says, it is possible, but you need to be skillful and lucky. The market seems to think that there will be a recession next year. Where are you standing on that?
So we don't have a recession as the baseline forecast. And I think when you listen to Secretary Yellen, what she said was, you have to be skillful, you have to be lucky. It is true, it will be very, very difficult, but that doesn't mean that the baseline scenario should be a recession. Chair Powell, in saying that they want to be nimble, means that they're going to tighten policy, they're going to be trying to pay attention to everything that's going on around them. And if they feel like they've gone too far, they're going to reverse course to try to engineer that soft landing. Maybe it won't be a soft landing, it might be a bumpy landing, but I think they'll try to avoid a recession.
This is what Chair said on the question of future rate rises, having discounted out a 75 basis point. Have a listen to what he said on 50 basis points.
Assuming that economic and financial conditions evolve in line with expectations, there is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings.
That's as much as walking in front of us with a red flag and a trombone, isn't it? I mean, all things being equal, it's 50 basis points going forward.
Yeah, I think that's right. And I think that what they're trying to do is really thread that needle by doing enough to tighten financial conditions without doing too much. I think the key there is if everything evolves according to their current forecast, then things almost never go exactly according to plan. But 50 definitely seems right for the next meeting in June. Whether you get one more at the July meeting, I think is possible, clearly, but it's going to depend on, do we see slowing, especially in the labor market? Do we see the sequential monthly prints on inflation starting to trend down? I think that's where they're going to have a real challenge to make a decision.
Because I'm relatively sad, I spent some time today looking at the year 2000. The transcript, in fact, of the last time we had a rate rise of 50 basis points. Then it was Greenspan, and inflation was a fraction of what it is today. Inflation back then, as you can see on this chart, was just under 4%. Now, interest rates were at 6%, and the committee's discussion back in 2000 was what the balance of risk was. It's very different today.
Absolutely, very different. It's funny, I was actually a staffer in the monetary policy group there at the Fed in 2000, and things are very, very different today. This will be the first hiking cycle we've seen, I think, roughly since the 1970s, where the Fed is raising rates to try to bring inflation down. The past couple of decades, it's all been about raising interest rates so that inflation doesn't start to rise too much. And so we are in a very, very different situation. They are trying to slow things down. They're trying to tame inflation. This is going to be a much more challenging circumstance for the Fed.
I know it's rear view mirror stuff, but did they just let this thing get out of control? I know Omicron came along when they perhaps should have been raising rates, but to talk about transitory in the middle of last year, when people like you were saying, no, it's not transitory. And if you look, you can see from this graph that we have on the screen, the takeoff in inflation since the beginning of 2021 has been phenomenal.
It has been remarkable. If I wanted to throw stones at the Fed and criticize them, I think holding on to the phrase transitory a bit too long could be one place to criticize them. I think holding on to how long they were buying $120 billion of securities per month, that's another place. But in point of fact, they saw that they made a mistake. Right. They changed their tune pretty dramatically. The 2-year note yield is up over 200 basis points this year alone, year to date. So they have changed very quickly. They've demonstrated to markets that they're serious about it. Markets are forward looking, and the market started tightening because the Fed demonstrated that they were going to hike rates. So I think you could quibble, but they have clearly repositioned themselves.
And finally, Seth, what do you see as the neutral rate?
Boy, that's such a difficult question. I mean, I'm sympathetic to the estimates between 2.5% and 3%, but I really think they're going to have to go beyond neutral now to slow the
Oh,
economy just because how robust it is. I think they're going to get up to just under 3.25% next year.
good to talk to you. We'll talk more. Thank you, sir. I appreciate your time. Question.